This is the kind of value that we try to bring to you at the weekly roadmap. You should be sharing that fact with your referral partners, with other originators that you know, folks in your office, folks in your area, to ask them to join. You can join as an Explorer member for free and then look to upgrade to the Navigator level, which brings additional premium content. We're going to continue to do more of these masterminds in the first part of next year. We're ecstatic to have today, we have Tom Davis and Shelley from Deep Haven Mortgage. They're going to talk about non-QM. They're going to talk about product. They're going to talk about sales strategies. They're going to talk about how to find these loans. It's absolutely the fastest growing segment of the mortgage business today, and particularly in purchase. And I can tell you as an originator, if you're not savvy with non-QM product, understanding how to originate, how to find these referrals, how to work with your referral partners, how to help their customers become mini landlords with 5 or 10 properties. If you're not developing those strategies, you're leaving an immense amount of commission compensation on the table today and or revenue for your company. So, Tom Davis is the head of sales for Deep Haven on a national basis. I tend to refer to him as the godfather of non-QM. I've worked with Tom. He's been on as a guest on the weekly roadmap a number of times. He, for my money, is one of the most knowledgeable people in the industry, both on product, on developing sales, on understanding how to find this business in your market, the strategies and tactics. I know he does these kinds of things for salespeople all over the industry every month. And we have with us today as well one of his co-employees as well that he works with, Shelley Griffin, also from Deep Haven. Tom, good morning. Shelley, good morning.
Good morning.
Morning, Brian. Thanks for the
Welcome to
intro.
the weekly roadmap. Welcome to today's mastermind. I'm going to stay up only to the degree that I may ask a few questions or add some points of emphasis. But given the fact that I really can't talk very well, I'm going to Tom, I'm going to turn it over to you. I know you have a deck and some additional information to work with
Yep.
as well, you and Shelley. And so, look, I have a simple question, right? I think many originators today are missing the non-QM opportunity in their market. I'm going to turn it to you to help them understand how to find it, how to understand it, the sales tactics that go along with it. And with that said, Tom, I'll turn it over to you and Shelley.
I appreciate it. Thanks, Brian.
All
Thanks for
right,
the
thank
warm
you, Tom.
welcome. Yep, love being on the roadmap with you. You bring a lot of content to originators and their referral partners, and that's why we're here. We're even though we work at Deep Haven and we're in the non-agency, non-QM space, we're really educators. We just happen to be in the non-QM space, and so super excited to talk about the opportunity. And all the things that you mentioned, and excited to have Shelley a part of this webinar as well. She's been in this space for many, many, many years as an industry expert, and so glad to have Shelley's firepower on today's webinar with me. So, high level, quick intro on Deep Haven. Deep Haven's been around since 2012. We were one of the early pioneers in the non-QM space, helped actually bring liquidity to the market, introduce products into the market, help develop even the DSCR loan and the bank statement loan. Very, very early adopters. So been in the space for, let's call it 13 years. We're known for our expertise, knowledge, and focus. And so we've been doing it for a long time. So this is what we focus on. This is all we do. And today, I'm not just going to talk about non-QM. I want to talk about the entire non-agency space, because non-QM is a segment of non-agency. So let's go ahead and get started. So if you look at just originations in non-QM.
Hey, Tom,
Yeah.
are you sharing your screen?
Oh, sorry.
Yeah, we
Okay.
can't see it.
My bad. I got too excited here. I'm talking non-QM. So let me go to my share.
He doesn't
Right
even
away,
need
we have a
notes. He can just
technology
rattle it
challenge.
off. Yeah, he's good.
Yeah. All right. Let me see here. Let me share.
Look, when I use the deck, it's generally to remind me what to say more so than what the audience needs to read.
Yeah.
Yeah. All right. Can you see my screen?
We're
Yeah.
good. Thank you.
All right. So look, 3 years ago, right? When the market was a $4 trillion market, there's plenty of opportunity out there. The low rates were at the lowest levels we've ever seen. We're in a different market. This year we'll finish around 2 trillion. right? So, and we went from, a space that there was a ton of refinance transactions, 75% refinance transactions, to a market, where today refinance transactions are, let's call it 20-25%. So we're in a heavy purchase market. And what we've seen is originators that kind of have focus in the non-QM space are really thriving in a challenging market and growing their business and looking at, helping segments of the market that traditionally they didn't focus on. And these are some very, very large segments, and we'll get into those opportunities. But last year, or actually this year, in the beginning of the year, we were forecasting non-QM to hit maybe 70 to 80 billion dollars in originations. We're going to finish around 100 to 115 billion overall. So as Brian said, major growth in this space. And so we expect going into next year, into 2026, originations to be about 150 billion in non-QM. If rates come down, marginally, let's call it 50 basis points, we expect non-QM to potentially hit 180 billion. That's on a $2 billion market or $1 trillion market, that's close to 10% of the market is going to be non-QM. And that's just non-QM, right? I don't think rates will come down materially over the next year or 2 years. Brian, I think the Fed's talking today. We'll see what they say. But every time I've heard you say it, every time the Fed cuts rates actually, Fed funds, rates actually go up. And so, another spot in the market that we've seen a major growth is the investor space. Year-to-date purchase transactions have been 30% of overall transactions. So I would challenge every loan officer that's on this call. Look at your book of business for the last year or year to date, and if it's not 30%, you're under indexing your production, and you should be focusing on investors because they make it's almost 1 out of every 3 transactions. And unlike consumers, where you might get a deal once every 5 years on a purchase, the investors on average are doing 5 deals a year, right? And some of these investors are doing 10, 20 deals a year. So if you build in a referral source with investors, you're going to grow that business, and it's going to be repeat business, which there's nothing better than that. Another area where we are seeing massive growth is the equity space. In equity, we expect originations next year to hit in that 120 to 150 billion dollar market. Potentially could have the opportunity to surpass, let's call it non-QM. And so we're sitting at equity at an all-time high, consumer debt's at an all-time high, whether it's let's call it the credit card, auto, student loan debt, right? Folks need to renovate their homes. Average age of a home is 40 to 50 years old. So people are looking to renovate their homes. They're looking to tap in their equity to consolidate. They're looking to fund their businesses. There's over 19 million investment properties in the United States. Those investors are looking to tap into that equity to go buy more investment properties. So, in today's market, right, second liens, including closed-end seconds and HELOC, should be part of your retention and recapture strategy. It's a great way to stay in front of the client to help them with their needs today. So as we look into 2026, look, we're coming off an all-time record year, record pipeline going into the new year. Things have not slowed down for us, and we expect this non-agency space that includes non-QM, it includes the equity, fix and flip, ground up construction, bridge, and jumbo to be overall a $400 billion market going into 2026 or in 2026. So that's 20% of the overall market. We expect to be non-agency. So continued growth, very bullish in this space. And, this is an area originators should be focusing on today.
I just want to emphasize your point, if I could.
Yeah.
1 in 5 mortgages in 2026 will likely be non-agency in nature. So as an originator, if you're not deeply involved and understand this, and look, I know Tom and Deep Haven and Shelley put a ton of educational stuff up available on their website. They do these kind of webinars. We're ecstatic to host them today. You're leaving 1 in 5 opportunities off the table if you're not totally savvy with these kinds of approaches. So if you
Yeah.
take nothing else out of this today, understand 1 in 5, I would argue it may be higher than that. You could see 1 in 4 transactions in 2026 be some form of non-agency slash non-QM.
And what happens if the agencies tighten up on their guides too? Then more of
Exactly.
that's
Exactly.
going to
That's my
non-agency,
point.
non-QM. And
Right.
we've seen that in the past with the Fannie and Freddie pulling back on second home investor. Let's call it, traditionalists think that the agencies shouldn't be in, do loans for high cash out investor or second loans. So, we've seen that kind of restriction. So who knows what will happen? But in today's market, you have to have access to all products to serve all borrowers. If you don't have access to all products, then you're at a competitive disadvantage and you're not able to tap into new referral partners. So we'll talk about those opportunities and what you should be doing and how you should be thinking about this. We're going to share some best practices. We have thousands and thousands of customers that we do webinars for, and we gather best practices and we share them with originators so they could actually grow their business. And one other thing before we get into the next slide, 2026 is here. You should have a non-agency strategy or have a plan going into 2026 on what markets you want to tap into, certain types of borrowers. Maybe each market's a little bit different, and these products will help you drive higher production, higher penetration into the areas that you want to tap into. So you should be thinking about 2026 and how does this play into your plan and your goals going into next year. Shelly, you were going to say something?
Yeah. I was actually having a conversation with a new customer last week that has never done any non-QM, right? They work with builders. They've always, stuck with traditional mortgage products. And a big question they all ask when you're having initial conversations with new partners is, what do you attribute the growth to? Like between 2023 and 2024 in this chart, what was that? How did it grow so fast, right? And from my perspective, the thing that pops into my mind immediately is LO adoption. I think it's super important for originators to focus on this product and not just learn about it themselves, but also take that education to their customer base, to their referral partners. That's where I saw the biggest jump, right? I still have calls every week from originators saying, this is my first bank statement loan, and I'll walk them through it. But LO adoption was the key in the growth of the non-QM space and education, which is why we're so focused on it, right?
Yeah, and I think only maybe 10 to 15 percent of the LOs out there have even originated non-QM. So as you get
Yeah.
mass
Yeah.
adoption, you're going to see the market continue to grow. So
100%.
I
Yeah.
agree with you 100% there, Shelly. Moving on to the next slide. So who is a non-QM borrower? Look, just like agency borrowers, there's non-agency or non-QM borrowers in every single tab. That is a misconception. I don't run into these borrowers because there's self-employed people in every town, right? You have in the self-employed, you have over 18 million people that account for 30 million businesses in the United States. Very entrepreneurial spirited country. Why do you think we've had the biggest migration ever in the last 75 years of any country? We have 40 million people that were not born in the United States. It's 15% of our population. They come here because there's opportunity, right?
Mm-hmm.
And a lot of the folks that come here, they're self-employed. That there's, demographics have changed. People, have multiple jobs. But there's as many self-employed people than there's veterans. And the VA program, that's a great program. If you're an originator, you should have a program that's focused or a suite of products that focus on the self-employed because they're high net worth, high income. So self-employed borrowers or self-employed people are in every town in the United States. I don't care if you're in Cody, Wyoming, or if you're in South Florida. South Florida has 6 of the top 10 self-employed cities in the United States. Very entrepreneurial spirited state. California, Brian, actually has like 2 or 3 of the top 10 cities for highest self-employment as well. So, and we see, let's call it California and Florida are 2 of the biggest markets, or if not the top 2 biggest markets in the United States for non-QM, but self-employed people are in every town. You have investors in every town, right? There's over 19 million investment properties that account for over 49.5 million doors in the United States. There's investors in every single town, right? You got high net worth borrowers, high income, credit challenge borrowers. Now, when non-QM came out in, let's call it 2013, non-QM was formed out of, solving creating a solution for folks that had credit events out of the financial crisis, whether it was a bankruptcy, foreclosure, deed in lieu, right? That was the product early on. Today, credit event borrowers is only like 2 to 3% of the overall production in the non-QM space. Talked about ITIN, foreign nationals, right? We talked about that. Over 40 million people were not born here. Where I live in South Florida, just in the condo market, over 50% of condo purchases in South Florida, whether you're in Broward County or in Dade County, are for foreign nationals that are buying investment properties in South Florida. They're buying condos, more than 50%. So if you're a loan officer in South Florida and you don't have access to a foreign national DSCR product, you think you're missing out on condo purchase market? Absolutely.
And
Right.
non-warrantable too, right?
Non-warrantable condos as well. As everyone knows, that's a feature, right? It's not the actual borrow, but non-warrantable condos are everywhere. And the agencies have pulled back. And then last but not least, think about your book of business over the last 10 to 20 years that you've originated. Some of us have been in the business longer than that, including myself. And all those people you've ever did a loan for, they all have equity. All of those borrowers are in past clients, are potential clients, or that have needs that you could serve with equity products, right? There's borrowers with equity in every town. And then last but not least, just what's the makeup? What does this borrower look like? As far as a characteristic. Our average FICOs on not just at Deep Haven, this is industry wide, is about 740 FICO, 68 LTV, DTIs are in the low 30s. So we're talking about well-heeled, high net worth investors, self-employed. These are borrowers that when you do transactions with, right? It's just a different level of your traditional borrower. It's just the way we're calculating the income and the way we're kind of serving their needs is a little bit different outside of agency, and that's where the opportunity comes in. Shelly, any color there on the borrower, non-QM borrower?
No, I think you hit it.
Excellent. All right, so getting into features, we talked about some features. Shelly, why don't you kick us off on some of our features and how folks could qualify. This is like where the majority of the non-QM is being done, right, with these type of products.
Absolutely. Yeah. I would say self-employed borrowers you focused on first under what the non-QM borrower looks like. We all have been in the business a long time. You've done, traditional financing, you get the tax returns, you give the borrower a pre-approval. This is what you're pre-approved for based on your tax returns. A lot of the most successful originators I work with, they still do that. They've just also asked for 12 months bank statements. So at one time, you can qualify a borrower based off of their tax returns. You can also give them a pre-approval based on using alternative loan documentation, right? It's going to have a different rate. It's going to have maybe different LTVs associated to it, but you're at least providing the options. For self-employed borrowers, we really see mostly 12 months business bank statements, personal bank statements as well. But you also have different options, right? I think the first thing you should do when you're talking to a borrower who's self-employed is, how long have you been doing it? Do you use a CPA? Do you flow a lot of the money through your personal account, or do you have a separate business account set up? Do you have an audited P&L or a P&L prepared by a licensed tax preparer that we can review? It's really just figuring out what's the best fit for that borrower. And one thing that we do is we calculate that income for you up front, even at the pre-approval stage. You don't have to have a loan set up in the system. We provide you with a worksheet, and that worksheet provides one response, right? This is what the income is based off of 50% ratio. But that worksheet can also help you calculate it using a P&L and using a CPA expense ratio, all on the same worksheet. So you don't have to recalculate income over and over again. You calculate the income from the bank statements. We figure out which one of those alternative products is best suited for them. So a lot of times too, we do make some exceptions. One of the most recent modifications we made to our guidelines was less than 2 years self-employed, right? So say you have a borrower who has been in the medical field as a doctor under a practice for 5-10 years. but they recently only went out on their own for the last year. Previously, that was disqualifying them. We needed a 2-year history. But when we can show that they've been in the same line of work, we can make exceptions there. So it's all about working with your account executive. If you're newer to calculating bank statement income, working with your account executive on what's the best fit for the borrower in this situation. Another one that we use often is asset utilization. So asset utilization is the ability to use assets to qualify a borrower without liquidating them. So it's not asset, depletion. We're not asking them to take those assets out of their accounts. We're asking them just to show us proof of the asset. And let's either create an income based off of that asset figure or just qualify them off of their total asset amount with no DTI.
And Shelly, on the bank statement feature, right? If you're qualifying someone off a bank statement, you can augment the asset utilization
Yeah.
with the bank statement. So
Yeah.
there's another way to qualify as well.
Exactly. You can augment if you're coming across DTI struggles using just their bank statement income or just their W-2 income or their retirement pension income, right? But they have all of these separate accounts that they, have on the side that they're not drawing from. Yeah, it's a solution to solve for DTI issues, but it's also, and we'll talk about this a little bit later, a product that you can go out and source pretty easily by using private wealth advisors and wealth attorneys. So asset utilization is a great program. I recently was at the MBA in Vegas back in October, and one of our accounts we've been working with for a long time just hasn't utilized this feature until we started talking about it. So he asked me to go onto his sales call and just talk about asset utilization, just something new for his sales team to really, take in and learn and go out and source.
Yeah, that product's great for, let's say, someone that's retired. They have money in a sizable amount of money in the bank. They're not
Mm-hmm.
getting any more income. You can just qualify that person off their assets, and they
Yeah.
can purchase a home.
Yeah, they may want to not to draw from those accounts early, right? It might be more beneficial for them to stay there. My husband has a pension that's just sitting out there. Just we're not drawing from it, right? But it's there, and we could use that as a source of income if we needed to. So yeah, unlimited cash out available on some of these programs, and no trade line requirements if you have a 700 or up FICO. So a lot of flexibility.
Yeah, one thing I would say, Shelly, I know we're going to cover some products and we're going to get into sourcing and stuff like that. But what I think would really like what if you're an LO and you're not a non-QM expert, I think what's important to help you learn the product and rely on a resource that could help you structure deals. And the account executive, having a strong account executive who knows how to structure deals and knows how to navigate the structuring of these files is extremely important.
Yeah, I mean, I think that's one thing that we realized pretty quickly is when we are educating new people on bank statements, I can send them an income calculator, but that might not work, right? And I want to make sure, let's talk through this. If I exclude deposits because we're not sure what they are, but you can prove that they're self-employed related, we can add them back in. What we do is we provide you with an income calculator, and then someone's going to follow up from our team, either myself or a CDA, which is a junior salesperson we have on our team. They're going to follow up and say, do you have any questions about this income? Does this income work? Do we need to restructure, or would you like to hop on a call to talk about other options? So I think that's really important, especially if you're newer to a product like this. But every non-QM borrower is different. And even if you've specialized in non-QM for years, there's going to be a situation that pops up that it just still doesn't quite fit. We know where we can make exceptions, right? We know just from experience and just doing non-QM over the last decade, we know where there's wiggle room on, hey, it might not work just as it is, but let's submit it for an exception and see if we can move forward. So that it just makes a huge difference.
Yep. All right, moving on. Some other features under DSCR. Can you just give us high level on this? I know, once again, 30% of the purchase market is investor transactions. This is about 45% of our overall production, but can you cover a couple features on DSCR?
Yeah, I think a lot of us, probably on this call are familiar with the DSCR product. It's debt service coverage ratio. If you aren't familiar with this product, we've got a ton of resources to help teach you more about it and deep dives into this product. But I want to focus really on some of the things that you may not realize you can do on a DSCR loan that you can do. So for instance, a big question we get is, reserve requirements. If you're doing a cash out refi on a DSCR, your cash out can be used to meet the reserve requirements. So that's great. We can use long-term rents or short-term rentals. The guidelines are going to be different. So again, this is a situation where you have your borrower or you're working with a realtor who has a borrower with an investment property that they're looking to get. You want to ask about their personal situation because it's going to be different what you need to gather based on if you're doing long-term rentals or short-term rentals, and it could be a pricing difference as well. So that's one thing that you want to make sure you get additional help in. But gift funds are allowed on DSCR loans, which surprises a lot of people. We also have different borrowing types. So many investors or savvy investors, and what Tom said earlier is investors, they're not just doing one loan and then packing it in. They're liking the revenue that they're getting from that investment property. They're going to use that revenue and get more investment properties. So, allowing a borrower to vest in the name of an LLC or close in the name of an LLC is big. A lot of them will require that. So if you're not set up with someone who has the ability to do that, we have those resources for you. We have a channel that even offers being able to draw the docs for you. So, LLC borrowers, natural person borrowers with LLC vesting, and natural person borrowers are all allowed under this program. We also allow foreign nationals on this program, and you have that no trade line requirement with a 700 plus FICO. One thing that you do want to watch out on this program is it's for investment purposes only. It's a business purpose loan. It's not subject to the same compliance restrictions as consumer purpose. It's very important that you are confident in the occupancy as investment, right? The only thing that would draw questions is, borrower has never owned a property before. They're a first-time home buyer. They're wanting to buy an investment property using DSCR. Some people might allow that. We don't allow first-time home buyers. We do allow for first-time investors. So that's something you'll want to make sure as you're checking the guidelines to see if your borrower is the right fit. But it is a business purpose transaction. So they're going to be signing a business purpose and occupancy affidavit. From an underwriting perspective, I was an underwriter for several years back in the day. I always want to make sure I point that out, right? You want to make sure this is investment properties only, but it's a great program, qualifies off of the property income, not the borrower's income. So there's no DTI calculation. There's no employment verification. So it's a very easy close, but with this program, the appraisal is everything, right? So you really need to make sure you're checking ahead of time, checking for comps in the area, looking at realtor.com or homes.com and making sure that you're setting the borrower up for success.
All good, great points, Shelley. Moving into the next slide. So closing seconds. Can you talk little bit about some of the features here?
Yeah, this is our fastest growing product. It's gotten our sales team really excited. It's got our customer base really excited. We're rolling people out on this every week. Some people have been slower to adopt the second liens, but I'm not really sure why. I think a lot of originators keep tabs on their book of business and they want to make sure that they continue to win that business from those borrowers for years and years to come. And one thing they can do for a retention strategy is offer a second lien product, right? If they don't, the servicer is, right? There's a lot of large servicers that are out there. I get letters in the mail every week on accessing my equity. So go back to your book of business and see what kind of equity position your borrowers are in and offer them this product. They might be needing to put a kid through college, or they want to put in a pool. Maybe they want to buy an investment property. Maybe they want to, whatever they need, they want to consolidate debt. This is a great way to access that equity. And one thing that we talked about too at the beginning is the equity position of our average borrower is, very low. A lot of the non-QM borrowers already had to put more money down in order to get into a non-QM loan, right? Our max LTVs are 90, sometimes lower based on product. So they are where their equity position is.
Shelley,
Yeah.
just a point. You said their equity position is low. Their LTV is low.
Yes,
Equity
that's
position
right.
is
Yes,
high,
their equity position is high. Great.
Yeah,
Thanks,
right.
Brian.
Yeah.
No, so I think this is a great opportunity to just stay in front of your customer base, make sure that you have this as a retention tool, and explore all the different options they have. They can use bank statements, P&L. There's no reserve requirements. We even offer a second lien for DSCR. So it's a growing product, and I think a lot of originators you don't have the luxury of just waiting for your phone to ring anymore. You really have to pick up the phone and call your customer base.
Yeah, it's a great way. I mean, if I'm as a loan officer, it's a great opportunity to get in front of your borrower, congratulate them on the equity, congratulate them on the low rate that you gave them, check in and see, where they're at in life, and are they looking to consolidate debt? Are they looking to do any home renovations, right? And it gets you in front. I can't tell you how many times I've seen this DSCR second lien product used where the investor has a 3.5–4% rate on their first mortgage. The property's cash flowing. They want to go buy more investment properties. So they take $100,000 second lien out. They use the cash and they use it as 2 deposits, and they go buy 2 more investment properties, right? So it's a way to leverage the equity to go do more deals. And so if that loan officer never offered a second lien to that borrower, then they wouldn't pick up 2 more investment purchases, right? And so, and Shelly, I think one of the most important points that you made is if you don't reach out to your borrowers and stay engaged with them, if the servicer, if the servicer that has that first lien, if they offer them a second lien, which all servicers are sending emails and calling the borrowers today, telling them access your equity, right? If they get the second lien and they own the first, there's about an 85% recapture rate. And more than likely, that borrower is not going to do the refi cash out with you. When it's time to do the refi cash out with you, they're going to do it with someone else. They're going to do it with the servicer. And so not staying in front of your customer today will more than likely, you'll lose them in the future. So not only are you going to lose a second lien loan, but you're going to lose that borrower in the future. And I just don't see rates coming down materially. So in order for rates to really for this product to go away, you need to see rates come below or get below, let's call it 5%. So I don't see rates going below 5% this year. And so this is a product that allows you to stay engaged and get in front of the customer and just allow you to have another conversation with them. So.
Yeah, and 2, I think, if they need the money now, right? Or they need it for their kid's wedding, they need the money for the renovation or whatever they might need it for. Like Tom said, you're more likely to capture that consolidation of the first and second when the rates do dip down. Hopefully they do.
85% of Americans who actually have a mortgage, 85% of them have a rate under 5%. So the folks that are in the 2s and 3s, they're not going to give up that mortgage. They're going to keep it. They're going to protect that cheap money. If they need access to capital, they're going to be leveraging their equity.
Yeah.
All right. So sourcing the non-QM borrower. So we talked about just like.
Hey, Tom. Tom. Maria, I see there's a question, and given you have a better voice than I do, there's a couple questions in the chat. One from Joe Reardon. Are you available to read that off for Tom and Shelley?
Yeah, I see it here. I could read it.
Okay, great.
So question, our company started as a broker wholesale relationship. First of all, thank you for the business and partnership. We appreciate it. Our company started as a broker wholesale relationship with Deep Haven. Now we're a correspondent. Is there any difference? And by the way, with Deep Haven, we have all multiple delivery options that makes us unique. So we offer wholesale, non-delegated. We actually do emerging banker will fulfillment, where we will do all the fulfillment for you, which is unique to the marketplace. We do traditional non-delegated, and then we do delegated. So as you grow and you grow your business, we can help you through that process. So, Sally, this valued partner of ours is a correspondent today. Question number 1, is there any difference in various products underwriting guidelines between the 2 channels? Question number 2, do you have a master matrix for all the LLPA, add-on LTV, FICO, occupancy, income types? They create their spreadsheets, and they need some help with qualification conversations on the fly when they're in the sales office.
Yeah, we do have a couple programs that are different on the wholesale versus the core channel. Not much, though. I would say 98% of the product is exactly the same, and even shared resource of our underwriting team. So it's all we're all underwritten the same. That being said, we do allow for some no ratio on our wholesale side. And sometimes when we launch brand new product, we will launch it on the wholesale side first, but not for long. Most recently is Super Jumbo. So yeah, there are some minor differences regarding the master matrix for the LLPA or add-ons from a pricing perspective. On the correspondent side, that all comes from your pricing engine. From a qualification perspective, like max LTVs, we just have our regular product matrix, but someone from our team should definitely be able to help you and highlight the differences. So I would reach out to your account executive. If you're not sure who that is, you can reach out to me directly after this call.
And all the LLPAs are on the rate sheet, right?
Yeah,
So
they're on the rate sheet, but a lot of times those aren't published, out everywhere, or they might not have access to it. So
yeah.
if you don't have access, we can definitely go over with where some of the LLPAs are, so you can watch out for it when you're having those discussions. And a lot of pricers too have a mobile version, so you could, price something out on your phone. But definitely willing to help, so
Yeah.
you can customize that.
Question number two, the questions are rolling in. Here we go. If a property is in a land trust, is it possible to do a close-end second, or does the property have to be pulled out of the land trust first?
I'd have to check on that one. I don't believe you can, but I can double check. If they want to have, they can actually email me, and I'll put my email in the chat um, with their specific question, and I'll on this one, I'll get back to them on it.
Okay. Yeah, that's
We
a
have a
unique one.
scenario desk. Yeah, we have a scenario desk that can get that
I
done quickly.
in a land trust. I don't know if that's possible. I would lean to no, but we'll check on
Yeah.
that. Yeah, there was another question. I was a little late. Will we have this slideshow? Will it be sent later? Yes, we will get you a copy of the slideshow that will be going out. And Maria, actually,
We'll put it out for you, Tom.
excellent, excellent. All right, so let's get back to sourcing. So now you have there's a ton of opportunity. By the way, in every market, there's opportunity. Either you get it or someone takes it from you, right? So that's the worst thing that anybody could do is take anything from my sales team, my family, right? Once again, there's plenty of opportunity. Either you go out there and get it or someone takes it from you. I'd rather take share than someone take mine, right? And the market's tough. So yeah, once again, plenty of opportunity. So there's plenty of opportunity out there. Now you have an understanding of the products. You understand the features, right? Where do you go find self-employed borrowers? Shelley, you want to cover these? A couple of these?
Yeah, I definitely can. There was also a quick question in the chat. Someone asked, how do you verify creditworthiness for foreign borrowers? We require letters of reference, so sometimes if it's like a Canadian citizen, a lot of times you can use a Canadian credit report so you can see their trade lines, or we'll take a look at any foreign credit report to see if it captures the amount of information that we need to verify trade lines. When you can't do it via a foreign credit report, we can accept letters of reference from their creditors to validate that. So I just wanted to make sure I got that answered. Regarding finding self-employed business owners and 1099 borrowers, really, you're thinking outside of the box. Your realtors are obviously a wonderful referral source and relationship, and they're technically self-employed too. So we do a lot of bank statement loans for realtors. So realtors, commercial realtors, board of realtors, get involved within your community to see if there's any local trade unions, the Better Business Bureau. Another one, community credit unions and community banks tend to portfolio a certain amount of their product, but there's some that they're just not willing to originate on their own. So those could be a really great referral source too for you.
Business bankers.
Yeah.
That's another one. We did a presentation in one of our customers' office yesterday, and his business is through the roof. And he's built relationships with all the business bankers in his backyard. One thing that's on here, I don't know if it's on the next slide, and I'd be surprised if it's not.
It is.
There it is.
CPAs
and CPAs and accountants, right? So the CPA, they're responsible for tax optimization, right? At the end of right. So CPAs, the majority of them do tax returns for self-employed people. So that is a phenomenal place to do to build relationships with a referral source that can send you self-employed folks. We have flyers for all our products, right? But dropping off flyers, presenting to CPAs. One of our top producers, he happens to be an accountant CPA. What he does is he goes to all these CPA conferences in his market, and he puts up a booth, and he says, I specialize as a loan officer in helping self-employed people purchase homes through bank statement loans. That's his niche. So he goes to all these CPA conferences and he puts up a booth, and he's the only person that's there for mortgage. And he specializes in bank statements. That's how he gets all his bank statement production.
Well, not only that, too, I think one of the ways you can calculate bank statement income is getting a letter from a CPA or a licensed tax preparer that says what their expense ratio is. Instead of using a flat 50%, you can use an expense ratio that makes more sense for that borrower's line of business, right? So say you're an insurance agent, you work from home, you really don't have any expenses. 50% isn't reasonable really for your line of work, but 20% is a lot more reasonable. If your CPA or licensed tax preparer states that, then you can use that. So I've seen originators actually, after they get a loan done, using a CPA letter, reach out to the borrower and ask, do you mind if I reach out to your CPA and let them know that I specialize in self-employed borrowers, right?
Now, yeah, I would say I would start with my own CPA and say, hey, I specialize in this. As you come across your clients and self-employed people that need financing, instead of changing the entire tax strategy so they could show income next year, right, or show more income to qualify for a home, I could help them through bank statements and showing the cash flow of the business. I could help them qualify for a loan. So I would start with your own network. Call your CPA, call your business banker, your attorneys. Tell them that you specialize in helping self-employed people qualify for a mortgage.
Yeah, I think too, when we kind of, for the sake of time, we'll go through this pretty quickly, but social media, I can tell you, I've been on TikTok probably too many times and seen someone talking about DSCR loans every single time I open up the app. It's like they must know what business I'm in, and it's the first thing that pops up. But people going live and answering questions, and I've listened into them and just heard what they had to say. I love it. There can be dozens of people on those calls just asking questions. He's handing out his contact information, like get the word out there. Again, I said the growth in the non-QM space, I believe, is because of originator adoption, and this is how they're doing it. They're educating other people. It's not just about the originator, it's them educating their customer base. So
Yep.
I think that's a great one. Hard money lenders, they don't want to keep these loans on their books for a long time. We see this a lot on the next slide, because we're going to talk about investment properties, but they tend to do shorter duration loans. They're going to need to refinance those off of their books. They don't want them hanging around forever. So getting in with them and letting them know that you have that offering is going to be really helpful.
There's a say the pitch again. I don't know which pitch. We've been pitching all day long. So maybe
Tom, if I may, the recording is going to be available to
oh,
everybody.
got it.
Yeah,
Okay.
so you'll have the pitch
Yep.
there. If it's helpful to the audience, let me know in the chat. I can also provide a transcript of this recording as well.
Awesome.
Excellent. All right, so let's move to the next slide.
Yep.
Finding the non-QM investment borrower. And Jill James dropped in the chat box, investor networking groups. I absolutely love those. But Shelly, we'll talk a little bit about that. Can you talk about how do you find investors?
Yeah. So
Hey, Tom.
I think.
Hey, Tom.
Yeah.
I'm sorry, Shelley. I just
Mhm.
want to say we have about 12 minutes left till the top of the hour. I just want to give you a time check. But
Okay.
we can go longer if you and or the audience can. We can go a few minutes past. So I just wanted to give you that heads up. Go ahead, Shelley.
Yeah.
I'm sorry.
Yeah, no problem. I want to highlight Jill too. Jill put in the comments earlier that non-QM saved me during 2022 to 2024. We found that with a lot of people that were early adopters and invested their time in it. I think that's outstanding. But finding investment borrowers, again, you're not just getting one loan, you're usually getting multiple. So attending these events, joining the national REIA, you can look up your zip code and find where they're meeting up all over the country. I think we looked one time on one of our sales calls, and there was multiple in just Tom's neighborhood. So
Yeah, I think in South Florida we have 6 investor REIA
yeah.
clubs, right? So if 30% of the market is investor transactions, Guess who I want to go be friends with? The investors at all the local RIA or local investor groups. And when I go in there, I'm going to be talking about DSCR. I'm going to talk about 5 to 9. I'm going to talk about second lien on DSCR. I'm going to talk about fix and flip, ground up construction. I'm talking about bridge loans. When I go in there, I want to have an end-to-end solution for all investors, right? So not only I can help them finance the build of the construction of the property, but when they need to do the takeout loan or the home is being sold to a consumer, I want to do that loan too. So the investor that's doing 5 deals a year, right? Potentially that's 10 deals because you can get 2 deals from every transaction if it's a fix and flip or a ground up construction. So I would be going to those RIAs just like we're talking about today, educating those investors in your marketplace that you are a market or industry expert in investor solutions. And this is a full suite of solutions that I have, right? That's going to give you the edge. That's what's going to allow you to pick up new relationships. And by the way, investors, just like loan officers, we have our own community. Investors have their own community. They know each other. Once you start building relationships with them, they tell their friends. Now you got more business because you got more referral business coming in.
Yeah, one person added in the chat too, why property management companies? I don't know if you want to answer that, Tom, but I think it's because they work with investors, right? That they're hired to work for investors, and just opening up that door saying, hey, please let the people you're working with know that I can help them with some financing, is a great way in.
Or the people that they manage the properties for, maybe the people that are living there might want a place to buy, right? Or maybe the property management company might want to buy an investment property.
Yeah. So Tom, for the sake of time, we've got some slides on our products next, if you want to flip through.
Yeah. All right.
And
let's talk
we'll kind of breeze through these. Yeah, very high end, because I want to get to the last slide, which I think is really important.
By the way, Tom and Shelley, we'd love to do this again. So we could extend this.
Let's do it.
We can, this is a 101 class. I'd love to get to 201, 301, and 401 with you.
Yeah, awesome. I think we have, we have probably 15 different decks, Brian. This is like consolidated, like high level real quick.
Got it. I assume so.
If your subscribers and would like to do one day on non-warrantable, or they would like to do something on, let's call it, just investors, right? We could go through that.
While Tom and Shelley are finishing today, drop into the chat topics or subject matters from this area that you'd like to hear more from Tom and Shelley on, and we'll get them arranged.
Yeah.
Awesome. So just really high level, we break out the products so they're pretty simple to understand. So expanded prime is generally what you're seeing of all the non-QM being done for self-employed borrowers, full doc, non-warrantable condo, high credit qualifying borrowers, but we do go down to a 660 FICO at certain LTVs. This is where we see most of our production in the owner-occupied space. Non-prime is what solves for some sort of credit issue, lower FICO, limited trade line, bankruptcy, foreclosure, mortgage delinquency, something like that. Something on the credit has moved them down to the non-prime program. The other programs on the next slide, Tom, are DSCR. So DSCR is all of our 1 to 4 units, down to a 640 minimum FICO, up to 80% LTV on cash out. That's where all the DSCR borrowers are being done for 1 to 4 units. And we also have a separate matrix and product for 5 to 9 units. So the characteristics are a little bit different, a little bit more restrictive on your DSCR ratio, needing to be a little bit higher, FICO minimum needing to be a bit higher. And then our third set of products really is equity products. So
hey, on the DSCR, before we move back into to equity on the DSCR, what kind of exposure will we allow for an entity or an investor to have with ePayment?
We generally look at 10 units or 10 million. So usually you're hitting that unit threshold first. We'll make some exceptions to go over that. That just needs to be cleared through your account executive and our credit team.
So having exposure up to 10 million with one entity or one borrower, that allows you to work with the professional investor, right?
Exactly.
Yep.
We're generally seeing all of those as LLC borrowers.
Correct.
Yep.
Right. Equity.
Yep, equity. We've got three different product options. We've got on the closed end side, we've got Equity Advantage, which allows for more non-QM characteristics like bank statements, non-warrantable condos, no reserves required on these products. And then we've got Equity Advantage Elite, which is going to be more of a tighter credit box. So you're looking at full doc borrowers only, but it's going to be your best pricing option. So if you've got a full doc borrower above a 680 FICO score, I would check out Equity Elite first. And then we've got the DSCR option. Um,
And,
new,
and Shelly, on the pricing on the equity, like, can you talk about what a rate, like a par rate that we're seeing is? Are we in the nines and tens? Or are we in the sevens and eights? Where are we at? I know the way this kind of product is priced is really competitive today.
yeah, it really depends on what kind of margin or you're targeting on this and basically your credit characteristics, but it can range. I mean, we're seeing rates in the sevens,
Yeah,
eights.
excellent.
And then the next one is our newest product, really something our whole team is excited about in our customer base. So it's a digital HELOC, non-QM characteristics allowed. So a lot of times you're put into this little black. Everyone loves HELOCs. We get asked about them all the time, but the customer experience isn't always great. They put in some information. It tells them they don't qualify and they can't really figure out why. Ours is more of a hybrid. So it is digital and it's very easy to go through the system, but there's someone behind the scenes that's helping. We can help with the income portion of it. We'll calculate the bank statements up front so the borrower is not guessing when they're trying to enter in their income figure. And it can easily, if it doesn't qualify a HELOC, it can be transitioned into one of our closed-end second options, or you can provide them the option right up front, which one's best for them, right?
And this is right, fixed, right? And or it's on the prime, right? Is what it.
Mhm.
So as the Fed announces cuts rates, the pricing here would improve, or the rate would improve.
Exactly. Yeah. So this is a great product as well. And right now it's a wholesale delivery option only. I know that was a question on some of the differences in the product. So right now this is a wholesale transaction, but every company, even on the correspondent side, so I run correspondent sales, I'm getting a ton of interest in this product.
Yeah, and I think another unique part of or feature of this is if it is a bank statement with most digital HELOCs, there's only a couple out there. So, but with most, right, if it's bank statements and it has to go through PLAG, that's a very difficult transaction, right? We actually have an off ramp for bank statements. We calculate the bank statements and actually can help your non-QM borrowers obtain a HELOC through a bank statement qualification. So. This is our own tech. Super excited about it. Have a ton of, it's an addition to the full suite of second liens, which includes your closed end, full doc, W-2, bank statement, P&L, DSCR. We have, a prime that's really like, let's call it down the middle, down the fairway, tighter credit box, really, really priced sharp. And then we have our new Equity Advantage HELOC as well. So it's a full suite of second products.
And somebody asked too in the chat, what's the max CLTV? It's 90 for owner occupied, 85 for second home, and 75 for cash or for investment.
And depending on the max loan amount, we've seen as high as goes $1 million. Our average loan balance on here's another misconception. Everyone thinks these loan sizes are small, but the average loan balance we're seeing is slightly over $200,000. So higher loan balances as well.
Hey, Tom, we have about 2 minutes till the top of the hour. I'm
Yeah.
willing to extend for 10 minutes if you guys are available.
Sure.
I actually have to be on a call in 2 minutes, but let's get into we got
Shelley,
two slides.
is
Two
Shelley
slides
available?
left.
I'm available.
Yeah, Shelly could yeah.
Yeah, we don't have too much more to cover today, but I
All right,
do
go
agree.
ahead.
We'd love to jump on a call in any and focus on any topic that interests your group.
We will do a follow. Absolutely, we'll do some follow-ups. But if you have to jump, I actually had a call, but I backed it up 15 minutes. And so, Shelley, if you can hang in, because there seems to be some questions in here, and then we
Okay.
can bring it to a close.
Sure. So one thing that we want to focus on is I think initially when non-QM rolled out, it was by default, right? You'd go through your denial pile and see if you have some sort of non-QM solution for anything that you previously denied. What we're seeing grow the non-QM business, and what I think a lot of people on this call did to grow their business, was using this by design. So going out and educating referral partners, learning about the product, becoming an expert, really will help drive your production. It's not just a fallout product. And I think in the past, that's what it was used for. So expanding to your referral partners, letting them know that you have this product offering. We even offer a white label referral partner training where we white label it for our company that we're working with. We present on their behalf. They don't know that it's Deep Haven behind the scenes, but we want to educate their referral partners. So that's something that we provide to our customer base, and we schedule these all the time. Utilize your account executive is another thing. So I hear all the time, I'll have a loan officer call me and say, sorry to bother you. You're not bothering me. Like, I'm happy to talk you through, help answer any questions that you have. We've got an outstanding scenario desk of underwriters that respond back extremely quickly with the guidelines. They can also review exceptions, but use your tools that are available to you, right? If you've got a whole library of training and you want to become a non-QM expert and you've never attended any of those trainings or reviewed any of the recordings before you went into a big meeting with a referral partner, you're not going to be successful. So I would say using your account executives and the tools that you have is going to be crucial. And attend the non-QM webinars that are available. So I think in the chat, we've posted some of the webinars that we've got coming up. We've also got some recordings of ones we've done previously. Attend them, listen in, and learn something. You don't have to know everything all up front. Again, that's why using your account executive is so meaningful, but know the basics so you can go in and have a conversation with your existing or new referral partners.
All right. I think we're at the end. Resources and tools. I'm going to have to hop. So Shelly, maybe you want to cover this while I hop, but
Sure.
Tom, thank you very much for
Yeah.
being on and for bringing Shelly with you.
Yeah.
Shelly, you've been great. Yeah, I can tell the audience is really engaged with you. Folks in the audience, again, please give us topics that you'd like to hear about. And Tom, I'll loop back to you and we'll get some more of these scheduled.
Yeah. And Shelly, maybe can someone share this deck while I hop off? Because when I hop off, you're not going to be able to share it.
I can just talk through what the rest is.
Okay.
You don't have to have it on.
Sounds good. Take care,
Awesome.
everyone.
All
Happy
right,
holidays.
Tom, thank you.
Thanks.
Yep.
Yeah, I think the rest is just visit us. Visit our website, deephavenmortgage.com. There's places that you can connect with us there, whether it's the contact us. I think our LinkedIns are posted onto the chat too, so you can interact with us there. Visit our resources so you can get a good look and see what we have to offer. All of our different product matrices are on our website as well. And don't hesitate to reach out, right? We are here to help. If you're looking at doing a wholesale transaction with us, I partner with our wholesale team all the time. I'm happy to introduce you to great AEs that can help on that side of the business. And on the correspondent side, we've got a great team of people who can have rolled out hundreds of different correspondents on this product. So feel free to connect
Shelly,
with us.
you've been fabulous today.
Thanks.
You're a great partner with Tom. We've had Tom on the weekly roadmap a couple of times. We'd love to have you back as well. And we'll work with you and Tom and get I saw some additional topics coming in like Airbnb and other topics on DSCR. So I know you guys, to Tom's point, you probably have 15 topics you could cover. And let's get some more of these scheduled as we move into the new year.
Awesome. Sounds great. Thank you guys so much for having me today.
Thank you. Thank you, everybody, for joining. Look forward to talking to you again soon. Be on Friday, 9 a.m. Pacific with the weekly roadmap. We've got Natalie Overturf is going to talk about planning for originators for 2026 and encourage you to do it. So have a great week. And
Awesome.
Shelly, thank you again.
You're welcome. Bye, guys.
Take care.